Hello, everybody. So, as you know, I have not trusted this market since November, since the shutdown of last year of 2025. And the market is still extremely brutal. The market is still behaving like a casino. And depending on how you look at it, you could construe that the market has behaved like a casino ever since 2020. And it continues. And it just continues. And so this is my case in point right here. So SoFi, keep in mind, what's the size of that company. It's 17 billion. Anyways, they're going to do probably 1.5, 1.4 billion in adjusted EBITDA this year. Proxy for cash flow, right? 1.5, 1.4 billion. Yeah, it's trading like a mall store from a pseudo PE standpoint. Let's look at the charts. Let's look at the other charts, right? Okay. 2021, stock was $15, right? Today, the stock is $15. Stock is $15, the same as 5 years ago. Look at M2 money mass. How much more money is there in the system today, right? Probably 50% more, something like that. Let's look at this stock, the revenue. The revenue 5x'd in 5 years. 5x'd in 5 years. We were at $1 billion in revenue trailing 12 months. We're now at about $5 billion in revenue in a year. 5x the revenue. Profit, very high, 1.5 billion EBITDA. I'm not even getting started on the strategic accomplishments of SoFi, which is strategically positioned to entirely take over a lot of a retail banking system. We don't need 7,000 or 8,000 branches. Bank of America has 8,000 branches. We don't need any of that. Right? I'm not even talking about the strategic fit of this company for the next 10 years. I'm just talking about the performance. 5x the revenue, nearly 1.5 billion in EBITDA we're going to get this year, adjusted EBITDA. The stock trading the same price as it was trading 5 years ago. Yes, this market has been brutal, and they've turned it into a casino. They just have. It's trading on vibes. The stock right now is down 12.5%. It's trading on vibes. And it's down 20.5% on what is widely regarded as a great quarter. And of course, they write these articles post-fact, so now they have to find a reason for the drop, and they say, the reason for the drop is because the tech platform is not growing as fast as we thought. The tech platform revenue falls. Well, you know what, Galileo, the tech platform for SoFi, to me, that was always an ancillary business. To me, that was always something they did on the side. This stock has been dismissed, and the market just keeps finding a reason to dismiss it. This stock, too, at first was dismissed as just a student loan refinance company. Do you remember the whole loan forgiveness era, the whole pause on student loans era? That stock was battered over and over again about the loan forgiveness. I remember these days clearly. It doesn't matter what these stocks do. Just the market is a casino. The market was like, we're going to sell it off no matter what. This is a stock that has halved since November. More than halved, actually, since November. It's down more than 50% since November. Okay, well, maybe that doesn't really matter, but we could talk about the results. Not a bump in the road. Not a single bump in the road. Look at revenue. Revenue is a proxy for strategic success. If you have revenue, you have money coming in. It's the best proxy for success is revenue. Revenue doesn't lie. You can't hide. You can't cheat on revenue. You can't play with buyback. You can't play with how you calculate your earnings and change the way you calculate your earnings. You can't play with accounting. Revenue is not to be cheated. Revenue is not cheated. Right? If I look at year-over growth, okay, we move from 35 to 26 to 38 to now 41%. Quarter over quarter, 41% revenue growth. So revenue growth increased. We have better revenue growth compared to last year, same year. Guidance is 4.6 billion. We had 3.5 billion in 2025. And quarterly growth is there, 1.08 billion, 1.09 versus 778 million last quarter, up 41%. Same story for EBITDA. Same story for adjusted net income. Firing on all cylinders. Firing on all cylinders. Look at lending originations. Same thing. Firing on all cylinders. Look at the results themselves. Go read the numbers. Plus, firing on all cylinders. But of course, the stock is down 13%, so they had to find a reason as to why the stock is down 13%. And they're picking the one thing that didn't go well, and boom, they're running with this with the headline. Guess what? A complex company, a big company like a SoFi, an innovative company, you're always going to find something to nitpick about. To me, that's not the reason why the stock is down. To me, the stock is down because the market is broken. That's why I keep saying I want to have a period of time where, please, the market behave like a weighing machine. Can we just behave like a weighing machine for like 6 months? And to me, this is a big threat to the stock market because prediction markets, in my view, they're going to compete against that. A lot of investors are going to notice this nonsense, and maybe they're going to use prediction markets to actually bet on fundamentals. I want to bet on fundamentals. Like, can I make a bet that the revenue of SoFi is going to double again in the next 5 years? Can I bet on fundamentals? Can I just buy the revenue growth? Right? I just want to buy the revenue growth. I don't want to buy the market's madness, vicissitude, views of a denominator. I don't want to buy the market sentiment. I just want to buy the revenue stream. Can I do that? Not yet. But in my view, synthetic stocks are coming. And you see these platforms like Kalshi, etc., they're getting better and better. Are we going to get to... I want to get to a world where I actually can buy the top line. I want to buy the top line. I want to buy some fundamental. I want to invest in the fundamentals. This market has not given you that. This market has not allowed us to trade on the fundamentals for a very long time. It's very annoying. So, you could go look at the presentation, go look at their rule of 40. I calculate it as a rule of 67. They track their rule of 40. Their rule of 40 is going up. You're talking about a highly, highly profitable company. Anyways, I absolutely don't get it. I think it's a steal. 0.18 right now, EV over GP over RG. I think it's an absolute steal. But this is the type of stock. The returns will be here when assets begins trading on fundamentals again, which is definitely not the case right now. Nothing trades on fundamentals right now. Seriously, like nothing trades on fundamentals right now. Maybe Nvidia trades on fundamentals. Even a lot of the AI stocks, I think they're too hot. Nvidia trades on fundamentals. That's about the only stock I can see that trades on fundamentals right now. Right? Anyways, Robinhood. I find Robinhood expensive. Don't get me wrong. I also find the price action of Robinhood today nonsensical. Like, it was widely expected that crypto is going to be weak. And so now they are saying crypto is the reason why Robinhood dropped 13% today. Maybe the reason is they were going to make every single stock drop today anyways because of a press conference at 1:30 with Jay Powell. And so you play with your orders, you play with the book orders or shadow orders, and boom, you make all the stocks drop because Fed Powell's speech at 1:30 this afternoon. Again, so Robinhood, I'm not going to say I don't understand why it dropped. I understand why it dropped. Robinhood, I find a tad expensive, just a tad expensive. On this channel, I don't know, have I said about on this channel? Like, I'm looking at Webull and eToro. I think Webull and eToro, as far as valuation goes, they're much more compelling than Hood as far as valuation goes. But they're, of course, a shadow. They're much smaller. They're way, way, way smaller. But in my view, do we see a world where neo-brokers don't win? Like, is there a world out there where neo-brokers don't win? Actually, yeah, there is. If we move full decentralized finance, if we move full crypto, that's one scenario where they don't win. But as long as we stay in this hybrid world, I'm not sure Schwab has that big of a shot. I'm not sure Vanguard has that big of a shot compared to a powerhouse like Robinhood. So if you try to extrapolate 10 years from now and think about how big Robinhood will be in 10 years, they actually have their own plan in the annual report, right? Talking about their 2024 to 2034 plan. To me, I see it as a neo-financial platform for all of your needs. That's why they launched banking. That's why they have a 3% cashback credit card. Anyways, you don't even have to follow what the company does strategically on a day-to-day basis to figure out that they're winning. Yeah, they're obviously winning. Their products are taking over. But just look at the numbers. If you just look at the numbers, like, okay, so in yellow, you have the net revenues. Since 2017, it's up only. Then you have the platform assets. Since 2017, it's up only. More than 300 and, or close to three, not quite, 320 billion. And this is, by the way, despite a very weak stock market where, yeah, their assets on the platform have dropped because the stock market has been low, has not performed as well. Revenue per employee, 1.6 million. What do you think the revenue per employee is at a traditional bank? This is a company, and this is the same is true for SoFi. These are companies where the staff is going to stay the same, roughly, maybe even get reduced a little bit. But the revenue, the number of customers that they serve is going to explode. This is a classic story. Old world businesses are being replaced by these new world businesses, yet the market is not noticing. Yet the market is just punishing these companies. So I understand the movement on Robinhood a little more than I do on SoFi, because Robinhood is kind of a high flyer in the space. So I get it for Robinhood. I don't want to say that I don't get it. But if you also look at the market today, how much of a Robinhood dropped today, how much of a SoFi dropped today, is due to the market as a whole, and is due to the fact that Powell is speaking in a little bit, and it is due to the fact that the market is a casino right now. Like, how much of that? Like HIMSS is down 5% today. Why? Go through the list of innovative companies that I cover on the channel, and you'll see they're down like between 5 and 10% for most of them right now. All together, correlation goes to 1. They've put these stocks into a bucket. These stocks need to trade on fundamentals. How many stocks out there are like SoFi? Like, if you look at this chart, look at this price chart. Like, can you think of a lot of stocks that look like this for the past 5 years? Because I definitely can. I definitely can think of a lot of stocks who are like this for the past 5 years, where since the past six months, the losses have been so nonsensical that we've gone back to the level of 2021, 2022. We need the markets to go back to normal. There is something going on under the hood. The denominator is not doing well. That's my take on this. The denominator is not doing well. We need a new Fed chair. We need this Middle East thing to stop. And for now, more opportunity to buy the dip. But guess what? We've not missed opportunities to buy the dip this decade. We have had a lot of opportunities to buy the dip on any stock, even Nvidia last year. We could have bought the dip. It dropped to like 85, right? And we might get new opportunities to buy the dip. Remember, a new version of DeepSeek is probably coming in the next few weeks, and that could spook the market. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.